All right. It is 12 o'clock. Hello, everyone. Welcome to Financial Fridays with Sanies and Equitable. Today's topic is tax time, plan accordingly. Sanies is excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. Before we begin, we'll hear a few words from our sponsor.
Who Equitable Advisors is. We're a large financial firm and been a strategic partner of CNEs for the last 10 years. In that, we've had a commitment to the K-12 marketplace, making sure that educators are educated about their finances. We've been able to give those members additional support that's needed to make some of the biggest decisions in their life, like preparing for their retirement and their kids' college education. When an Equitable Advisor meets with a SANES member, what our objective is to give them the confidence that they need going into retirement, making one of the biggest financial decisions they'll ever make in their life, to best assist them prepare with whatever their financial goals are. Equitable provides SANES members include financial resources and articles, complimentary financial profile meetings and an asset map, professional development educational webinars to units. And then in 2025, we're going to be doing a Ready to Retire series for people that are at least 1 to 3 years out from retirement and want to know how to finalize next steps. One of the benefits of being a CNEs member is on the first Friday of each month, we've always provided a Financial Friday series. It's a 30-minute series that goes from 12 to 12:30 that's presented by local regional representatives at Equitable that manage each region within SANES on a variety of topics, including planning for the future, student loan forgiveness, and healthcare and retirement. What I would want SANES members to know about the Equitable relationship is that you're going to have questions that come up, and there's always a tremendous amount of resources. There's an email address, SANESmembers at equitable.com, that can be utilized. And there's always somebody on the other end of that email address to address any questions, comments, or concerns. Best time to plan for retirement is today. Looking at the future immediately or as soon as you're able to, realistically, you're going to be best prepared for that future. Sometimes, if people haven't looked for the financial future yet, minimally 7 to 10 years out from retirement, that threshold absolutely must start because you still have time to make effective change, tweaks, and adjustments to your financial situation to best be prepared. The most important message for CNEs members to know is that Equitable Advisors is there to help them as life comes up. It is normal and it's going to happen where there's questions, concerns, things you're unsure about, and you've got a tremendous amount of resources to help and support you through that.
All right. So joining us today from Equitable is Sean Richardson. Sean, thank you for being here. And just to let you guys know, a little housekeeping, this session is being recorded and we will save questions until the end of the presentation. But feel free to add questions to the chat at any time and we'll get to them at the end. Our Q&A time is best used for general questions, but please know that the Equitable team is available at any time to answer your personal questions and confidentially. You will find contact information for Sean and other regional reps at sanies.org. And now I will turn it over to Sean.
Awesome. Thank you, PH. And thanks everybody for joining here on Friday afternoon to talk a bit about some taxes. It's a timely topic of discussion here. And of course, happy to answer some questions towards the end here. So I'll go ahead and get my screen shared. The goal today is to talk a bit more high level around some taxes, some things to consider, enough to provide some value in education, not enough to put you to sleep here at noon on a Friday. So PH, is that sharing okay?
Yes, perfect.
All right.
It was, yeah, there you go.
Good now? All right. So first, of course, this is not going to be any legal or tax advice. Again, relatively high level today with some of the information that we'll go over and we dive in as much in depth as we need to with some questions. But first, pretty basic here to start off. If we look at just the tax brackets from last year and then tax brackets heading into 2025, the tax brackets themselves will stay the same heading into this year. The difference is each year with inflation, the amount of income that you can make within each respective tax bracket will continue to adjust or increase slightly with inflation each year. But listed up here are just the current federal tax brackets. The lowest bracket would be 10% all the way up to 30%, 37% federal taxable income rate. Now, generally, there's really three main forms of income out there. There's earned income, which we all have from working and earning a wage. There's unearned income, which would be future pensions or Social Security, or it could be dividends or interest that we may be receiving off of investment accounts or stocks. It could be high yield savings account interest that we're receiving with interest rates being a bit higher nowadays compared to maybe a few years ago, where there wasn't as much of a high yield interest accounts out there. On those types of accounts, you do pay ordinary income tax. And there's investment income. So this would be more so from selling a stock or a mutual fund, or could be selling a real estate property where there was a profit on it. You are typically going to potentially pay a little bit less tax from that type of sale of an asset. It would be called capital gains taxes, which the brackets are a bit different. It would be anywhere from 0%, 15, or a max of 20% for that type of tax on investment income. To touch a little bit on the different ways that somebody may file their taxes. So of course, pretty straightforward with somebody that is single filing as themselves. The tax brackets here for somebody that's making between 0 to 11,000 of income, they would pay 10% on that first 11,000. From 11,000 up to 47,000, we would pay 12% federally. This is not including any state taxes up here. And then again, the more that we make, the higher the income bracket we could get into over time. There's also, not as common, but married filing separately. So those are for married couples that want to record their own tax returns or respective income on those tax returns. And really the only times where we may see somebody do this could be, for example, where there may be a higher income earner and maybe a lower income earner that has student loans outstanding. And in order to have a lower monthly student loan payment to qualify for the income-based student loan repayment plans, they may look to file separately to have a lower monthly payment for themselves. So they pay a little bit less over time to then qualify for the student loan forgiveness down the road. There could make sense in that scenario. Another scenario could make sense if there's one spouse that incurs significant medical expenses and it's over 7.5% of their income. They may look to file separately so they have the ability to deduct that from their income to help them save on taxes for that year. Last scenario where that could make sense is if there was some liability issues. If we owed some money to the IRS and we wanted to keep things separate, we could file separately. Some major things to consider though, if somebody was looking to file married and separately, we would lose the ability to have a dependent care credit or child care credit. We would lose the ability to deduct some or have a credit for any higher education expenses that we may incur for seeking any higher education out there. We would not be able to deduct our student loan interest. And then also the income limits, as you make more money over time, there's certain thresholds where if you cross that income threshold, you're not able to contribute directly to a Roth IRA or a traditional IRA. Those income thresholds are significantly lower when we file married filing separately. These are just a list of the income thresholds for, again, married filing separately. Income threshold amounts are going to be a bit lower than they would if we were filing most commonly, which can be married filing jointly. Also not as common, but filing as head of household. So this would be a scenario where, oops, there we go here. Filing head of household, we must either be unmarried or in a stage of separation or divorce, and paying for more than 50% of the overall household expenses. And we must live with a qualified dependent for more than half of the year. So essentially, being head of the household, taking care of majority of the expenses, 50% or more, with a qualifying dependent that's essentially relying on us for support. Some of the benefits there, it's going to be potentially a higher standard deduction amount. So a standard deduction is simply an amount of income that if we take the standard deduction we file for our taxes, which nowadays most people do, it's amount of income that we can essentially deduct right off of our income that we don't have to pay taxes on. And that's available for everybody out there. And then potentially for higher income tax thresholds. So I'm not going to dive too much into the filing head of household, and it's not too common to file out there. But I'd say most commonly for those that are married would be filing jointly. There's a standard deduction or $29,200 that essentially we can take right off of our income that we're not having to pay taxes on. So it again helps reduce the taxes. There's also higher income thresholds for married filing couples. We're going to see that threshold amount is going to be essentially doubled compared to if we were filing single. So income from 0 to 23,000, paying 10% tax on that amount. From 23 to 94, we'll pay 12% on that, so on and so forth. Now, a common misconception, oftentimes somebody may think that if I got an increase in pay and it was enough where it pushed me up into the next higher tax bracket, that I have to pay that amount of tax on all of my income, which is not necessarily the case. So for example, if there was somebody that was filing single with $110,000 of taxable income and it pushed them up into the 24% tax bracket, that would not mean that we're paying 24% tax on all 110,000 of income. It would just be the 10% on the first 11,000, 12% from 11,600 to the 47,000, so on and so forth. So in this case, if the income was if the taxable income amount was 110,000, we'd only be paying 24% on roughly that additional 10,000 of income coming in. Now to hit on some of the deductions, there's only so many different things that you can do out there to reduce taxable income today. But oftentimes throughout planning conversations with our clients, not only are we looking to seek out, is there any way we can continue to help reduce taxes today, but also equally important is setting ourselves up for potential to have a very tax efficient retirement plan down the road in the future as well. So we'll touch on towards the end some different types of accounts that can help with that. So first, and everybody can qualify for the standard deduction. You don't see as much of the itemizing going on. So a handful of years back, the standard deduction amount significantly increased. So for those that would look to itemize their deductions, typically would have a significant amount of either medical or dental expenses, taxes and interest paid, whether it's on things like the mortgage, for example, student loan interest, et cetera, or making gifts to charity, which with a standard deduction nowadays, you're not going to be able to deduct those gifts to charity, which if you were making significant gifts to charitable organizations, it could make sense to itemize in that case. The only way that it would make sense to itemize if those total itemized expenses add up to be more than what the standard deduction amount would be. If not, you would continue to take the standard deduction as normal. And some of the common tax forms out there, so those that are earning wages, W-2 form that comes through, which needed to file for taxes. If you have investment accounts or high yield savings accounts at 1099, and there's different forms of the 1099 itself. But if we're receiving any dividends or interest from any investments or any miscellaneous 1099 income coming in, there would be a 1099 form that we would need to file for taxes. And depending on the type of interest or dividends that we're receiving, it's going to depend on how much taxes we're paying on it. And then also a 1098, this would be for interest that you're paying on a mortgage or on student loans that you are able to potentially deduct from your income. So if we look at different ways to reduce your taxable income in the current year, there's, of course, saving into pre-tax retirement accounts, whether that's 403Bs for those within the school districts or not-for-profits out there. There's traditional IRAs, that allow you to make contributions to reduce your taxable income today. And eventually when you take that money out in retirement is when you're going to pay your income tax based on how much income you have in the future in retirement. The ability to save into a health savings account or a flexible spending account. In order to qualify for a health savings account, you need to be on a high deductible healthcare plan. However, a health savings account is the most tax advantageous account that's out there. It's the only account that you can put money into pre-tax, so reduce your taxes in the current year. The money can be invested, will grow tax-free, can also come out tax-free in retirement or outside of retirement or at any point in time for any medical related expenses or qualified healthcare expenses. You can also save into a 529 or a college education savings plan. So within a 529 plan, you get no federal tax deductions, but in New York State, per person or for a married couple, you can do up to $10,000 of contributions to get a $10,000 deduction on taxes at the state level. It will not help on federal taxes on contributions going in. That money that's invested in a college savings plan will grow tax-free and then can come out tax-free for qualified education expenses. So that's K through 12, could be for private school, or it could be for higher education, whether it's college or trade school, so on and so forth. There's also the ability for the educator expense deduction. So I'm sure many of you may spend more than $300 a year for supporting the schools or your classroom, so on and so forth. But you are able to deduct up to a max of $300 per educator in the household each year. And then over on the right, the most commonly used tax credits that we see out there. So the student loan interest deduction. So if there's student loan interest that's being paid, you can deduct up to a max of $2,500. So a child tax credit, if there's dependents or children in the house that are 17 years of age and younger, you can receive a credit back on our taxes for up to $2,000 per child. Dependent care credit, up to $3,000 to $6,000. American Opportunity Tax Credit, this would be for any qualified education or higher education expenses. We can receive up to a max of $2,500 in deductions there with a credit there. Lifetime learning credit, so that would be continuous or ongoing future education and higher education where we can continue to get some of the deduction back or the credit back on our taxes up to also a max of $2,500. Adoption credit, there's earned income tax credit. This would be for somebody that may have relatively lower household income. You can still get your tax deduction by making a contribution to a retirement account, but you can also, on top of that, receive a credit if income is below a certain threshold. More popular nowadays, the EV tax credit with electric vehicles, depending on the type of car somebody may purchase, they could get a credit back for that, or solar, clean energy. There's a handful of credits available out there if you are installing solar panels to the house, for example, or more efficient windows, so on and so forth. And then just to hit a bit on high level different retirement plans out there and some of the basics and taxation around them. So many employer sponsored plans, 401ks, 403bs, school districts offer both 403bs and 457 plans. They both work relatively similar. If you do have both of those options, you're actually able to contribute to both if you'd like to. And some plans out there within the schools, they may offer Roth or the ability to contribute to an account, pay the taxes. The income tax is already withheld, so the money's invested after taxes. It can grow tax-free. The growth comes out tax-free as well in retirement versus pre-tax, again, reduces our income today for the current year, and then we'll pay income tax when we take that money out in the future. Some questions that get brought up is which one's better, the Roth or pre-tax? It really depends on where somebody's income levels are. If we're starting to get into a higher tax bracket, it could make sense to continue to do pre-tax contributions, but maybe early on in the career, or if there's certain income thresholds where it may make more sense to do Roth. However, it could also make sense to do a mix of both. So that's where part of the planning conversations with an advisor comes into play, we can help point in the right direction on that end. So again, just to recap with the different tax deductions, whether it's today or having to pay tax in the future or having it be tax-free in the future. So if the goal is to reduce current income taxes, we would look at contributions going into a pre-tax 403B or traditional IRA. It allows you to reduce your income taxes today. While the money's growing in those accounts, you're not, of course, having to pay taxes while it's growing. Eventually, you do have to take, when you do take money out in retirement, that's when you're going to pay your income taxes. And if we want to reduce our income taxes down the road, that's where some of the Roth contributions come into play, or after tax. So that's where we don't have to pay additional tax on the money's invested. That's simply just when we receive our income, we already paid our income taxes. You've had it withheld on your pay stub, and then the contribution goes in. All of it grows tax-free, and then again comes out tax-free in retirement down the road. There's also, looking at, not all school districts offer the Roth 403Bs. A handful of them nowadays do. There's also, again, Roth IRAs. Same concept applies there. So just to give an example of reducing current income with pre-tax contributions to retirement accounts. In this example, if somebody was making $50,000 before taxes, they contributed $3,000 throughout the year to their retirement plan. Now on paper, it only looks like they made $47,000. They've reduced their income. And if we were in effective tax or paying tax of around 20%, we would have $9,400 withheld for taxes, which gets our net income or take-home pay down to $37,600. So in this case, if we look at how much tax we would have saved by simply making the $3,000 of contributions, instead of giving the IRS an additional $600, that's money that we got to keep for ourselves. We save $600 in taxes that year by making those pre-tax contributions. Now, over time, even small changes or an increase in contribution each year over time can add up to significant increase in retirement savings down the road in terms of our investment balances, but it's also going to, of course, help us continue to save taxes along the way each year. So in this example, if somebody were contributing $500 a month, and in this case, they were an effective or average tax they were paying on their income was 25%. We just multiplied the 500 times 75%, or accounting for taking home 75% of that, 25% of taxes. When we actually make that $500 a month contribution, because it is coming out pre-tax, it really is only going to feel like $375 is going to be coming out of our paycheck that month before taxes are coming out. So it's feeling like a much lesser amount, which can definitely help over time. And then here's going to be a different example of reducing future income taxes, because again, with the Roth, we do not have to pay taxes on any of that money when we take it out in retirement. Another big difference is there's also no required minimum distributions, which for any pre-tax accounts, so regular 403Bs, traditional IRAs, the required minimum distribution age today is 73. That's going to increase up until age 75 going forward. At that point, once somebody hits that required minimum distribution age, you're forced to start taking money out each year. Just the IRS saying, you haven't paid tax on that money for long enough, it's time to take some money out and pay taxes on it. You do not have to take any required minimum distributions out of Roth accounts, whether that's Roth 403B, Roth 401k, or Roth IRAs, for example. So in this example with a Roth contribution, money's going in after we already paid taxes on it, continuing to get that tax-free growth. Over time, in this example, if we put $3,000 away in Roth contributions for the course of 10, 20, or 30 years, assuming a relatively conservative 6% growth rate each year in the market, after 30 years, 161,000 of earnings would all be having the ability to come out tax-free and no longer having to pay any tax on contributions or the profits or earnings that you're withdrawing in retirement. That would save roughly $32,000 in taxes if there was an effective tax rate or average tax we were paying on our income at that point, about 20%. So just some key things to remember going forward there. So each year as income changes and financial household picture, definitely changes over time, just reviewing contributions to see what is going to make sense in terms of pre-tax or Roth. Of course, always encouraging our clients to continue to increase contributions as income increases over time. Always looking for different tax credits or tax deductions that are out there, whether you use an accountant or nowadays things like TurboTax and whatnot. Typically, they point those out for you if you're eligible. And then preventing any tax consequences by avoiding loan defaults or any hardship withdrawals, which would be taking money out of retirement accounts before the retirement age. Early distributions, so if we needed to withdraw money out of a retirement account before we're eligible, then there would be a 10% IRS penalty and taxes involved. So anytime we can avoid that through different scenarios or looking at all the different options that are out there for our clients, of course, makes sense to do so. So I know we're coming up short on time here, so I'm going to stop sharing my screen here. I see that we may have one question here. Let me try to stop this. All right.
Yeah, you stopped it. Yeah, there's one Q&A question. Did you see that little one on the Q&A?
Kids college financial aid, scholarship, and work study internship earnings need to be claimed. So it's like the question is kids college financial aid, scholarship, and work study internship earnings. So short answer, potentially yes, in terms of depending on how much the internship earnings are. If it's above the amount of the standard deduction, there would be some taxes that would potentially need to be paid on that amount. So short answer, most likely. But again, depends on the scenario. That's something that I'd be happy to follow up with because again, it kind of depends situation with that. And then any other questions there at all?
All right. I don't think we have any more questions. Again, if anyone does have any questions, please you can find our information. You can find Sean's information here, and you can find any other information for regional reps on our website, sanies.org. Thank you very much for everyone for attending. Thank you to Sean for sharing this presentation, and we hope everyone has a wonderful rest of their day.
Thank you, PH, and absolutely everybody have a great rest of the day here and enjoy the weekend.